When the generalist investor is motivated to come into the precious metals because of the momentum established by gold and then gold stocks, when they come into the market leadership changes from gold to silver. I guess because of the lower unit value for silver. I don't know. What I do know is this: when that happens, you won't need Rick Rule to tell you it's happening.
And I suspect what might happen is that gold and silver and commodities are going to go up much faster versus the dollar than the stock market will go up versus the dollar. And you will have to measure the stock market performance.
Rick Rule, a seasoned investor with decades of experience in natural resources and precious metals, offers a compelling perspective on gold's remarkable performance over the past quarter century. The precious metals journey from $253 in 2000 to approximately $3,250 today represents an extraordinary 11-fold gain that underscores what Rule describes as steady arithmetic over drama. The historical context of gold's performance reveals the metal's sensitivity to global events and economic uncertainty. In 1990, gold traded at $400 per ounce before declining to $280 by early 2000, a period when investors largely abandoned the precious metal in favor of other assets. However, the tragic events of September 11, 2001 marked a pivotal turning point, ushering in a new era of international tension and fundamentally altering investor sentiment towards safe haven assets. Recent technical developments in gold pricing have reinforced the metal's bullish trajectory. Gold settled above the crucial 50-day simple moving average resistance level at $3,320, after briefly testing offers above the 21-day SMA at $3,350. Rule identifies several fundamental drivers that typically propel gold prices higher, though he notes with concern that these forces, inflation, currency devaluation, and geopolitical stress, often coincide with broader economic and social challenges. A weaker US dollar and lower interest rates enhance the appeal of non-yielding assets, such as gold. At the same time, economic and geopolitical uncertainty strengthen the metal's role as a reliable store of value and safe haven investment. Perhaps most significantly, Rule believes the current gold bull market is still in its early stages, estimating that investors are witnessing only the first quarter or first third of this cycle. Now experiencing his fourth gold bull market, Rule's assessment carries the weight of decades of market observation and suggests that gold's recent gains may be just the beginning of a much larger move. Before we begin, don't forget to like, share, and subscribe. 97.4% of viewers haven't subscribed. Be part of the 2.6% who have by hitting that button and turning on the notification bell so you never miss an update.
I guess older people like me need excitement less and profits more. When people say to me, Rick, when's the gold price going to move? I say, year 2000, it was $253 then. Now it's $3,250. I mean, come on, it's up 11-fold, something like that.
Right.
People want drama in their lives. That's not what I want. I want arithmetic in my life, and I'm getting it. This will be my fourth gold bull market. It will either be the most dramatic or the second most dramatic I've ever experienced in my life. They follow very predictable patterns. They come about when people are concerned about the maintenance of their purchasing power in dollars. People are concerned for good reason. They start with gold. This one started with gold. They move on from gold to the best of the best. The Agnico Eagles, the Franco-Nevadas, the Wheaton Precious. Guess what? This one did the same thing. When the valuation discrepancies appear, two things happen. The value arbitrageurs come down the quality trail, and takeovers happen. That's what's coming next. At some point in time, Ivan, I don't know when, to be honest with you, when the generalist investor is motivated to come into the precious metals because of the momentum established by gold and then gold stocks, when they come into the market leadership changes from gold to silver. I guess because of the lower unit value for silver. I don't know. What I do know is this: when that happens, you won't need Rick Rule to tell you it's happening. Those are really, truly dramatic moves. But, we've had pretty good moves already. Anybody who happened to be in the GDX or the GDXJ in the last 12 months, if they're complaining about something, they need their head examined. This is a very, very, very generous bull market already. And I think, sadly, I say sadly because the things that move the gold price up are usually deleterious to the rest of your life. Sadly, I think we're in, the first quarter or the first third, the decline in the purchasing power of the dollar, I think, is going to be inexorable. This will merely speed it up. We've talked earlier on your show about what I call the math of America. The fact that the IRS says we have $141 trillion in private net worth, and the current debt is crowding $37 trillion, growing by $2 trillion a year, and the off-balance sheet liabilities exceed $100 trillion, growing by $2 trillion a year. So if you're worth 141, and you owe 130 net, and what you owe is increasing by $4 trillion a year, the problem is fairly obvious. And rather than addressing that problem, this budget exacerbates it. Now, we've talked before, Ivan, about the fact that I think the only politically feasible way out of our problem is to depreciate the value of the US dollar. In other words, honor the nominal obligations to bondholders and to Social Security recipients like myself while inflating away the net present value.
Right.
The only alternative to that I can see is an honest default, where we say to the bondholders, too bad, so sad, we lied, no money, strong letter to follow. And we say to the old geezers like me, yeah, you paid in for 50, 60 years, so what? There's no money. You don't get any money. That's not what politicians do. So what I think happens is what happened in the decade of the 70s. I think we reduced the purchasing power of the US dollar by 7.5 or 8% compounded for 10 years. So that while we don't reduce the nominal debt, we reduce the net present value of the debt and make it therefore more serviceable with inflated.
Mario Innecco, a former banker turned market contrarian, advocates for a fundamental shift in how investors measure market performance. Rather than relying on traditional dollar-based metrics, Innecco argues that evaluating stock markets in gold terms reveals the accurate picture of value creation and wealth preservation. His contrarian thesis centers on the belief that gold, silver, and commodities will significantly outperform the dollar, making gold-based measurement essential for understanding fundamental market dynamics. This approach challenges conventional analysis by treating precious metals as the ultimate benchmark, rather than merely as additions to a portfolio. Recent market movements support Innecco's dollar-skeptical outlook. Gold gained 0.6% to $3,293.55 per ounce on Monday, driven by U.S. dollar weakness as investors awaited Federal Reserve policy signals. The precious metal recovered from its lowest level since May 29th, demonstrating the monetary dynamics that Innecco believes will define future market relationships. According to Innecco's framework, investors measuring success purely in dollar terms may miss the larger story of shifting monetary conditions and genuine value preservation. As economic data influences Fed policy expectations, the inverse relationship between dollar strength and gold performance illustrates why he considers gold-based analysis crucial for navigating contemporary markets. Let's get back to the video.
And I had Michael Oliver from Momentum Structural Analysis the other day. He thinks the stock market is ready to turn and go down sharply. But I think what we might need to look at is the stock market in terms of gold, because that will tell the real story. And I suspect what might happen is that gold and silver and commodities are going to go up much faster versus the dollar than the stock market will go up versus the dollar, and you will have to measure the stock market performance in terms of gold. So we'll have to look at the Dow gold ratio, as you can see here, and I suspect that this ratio that you're looking at could turn back south and drop massively. That would be, I would say, the crack up boom. Or Michael Oliver could be right. Even in dollar terms and nominal terms, the stock market might go down during a crack up boom because it's gone up so much already in the last. We've got the stock market closing at all-time highs, the S&P. We had gold yesterday closing at an all-time high on a quarterly basis. Silver closed above 36. That's the second highest ever closing. And we've got the dollar as well. That's not looking good either. The dollar closed, as per the dollar index, below 98.34. So according to Michael Oliver's Momentum studies, that was the line in the sand. We closed in the 97s. I don't know exactly where. So this is telling me that this bill, unfortunately, is probably going to go through, and people are going to start to wake up. And what's the way to protect yourself? Well, hopefully you've been doing it for the last few years or even more, with having a little bit of gold and silver outside the system, because what that does that neutralizes the loss in purchasing power, the loss of value in the dollar. So you will end up, your assets, let's say that are denominated in dollars, are going to lose a lot of their real value, but you're going to have a little, you're going to have the gold and silver to make up for it. That's why it's an insurance. And of course, I think gold and silver miners, they rallied well yesterday on the close. They're going to continue to do well. So yeah, keep an eye on the Dow gold ratio. Keep an eye on what's going on in Congress. It's a crazy, crazy thing. And I think Trump is going to get his way. Of course, Ron Paul and Thomas Massie have been very critical of this. And it looks like Elon Musk agrees with them. But of course, Donald Trump thinks that this is the way to get things going. Well, it's been tried in the past. It's called Keynesian economics. They tried it in France during the revolutionary period, where the mandat territorial and the assignats went down the drain. It was just to kickstart the economy, right? Just like Trump is saying. But the problem with that is that you get the sugar rush, and then the effects go down again, and then Congress will come out, just like the National Assembly in France. Oh, we have to do another issue, and you keep doing it, and one day everything implodes. They tried that in Germany. They tried it with a continental dollar. It never works. I don't know why people believe that this time it will.
Gold continues to show resilience, benefiting from a softer dollar and investor caution ahead of key economic data. Despite earlier weakness, the metal regained momentum and remains on track with its upward trend. As uncertainty around monetary policy persists, both gold and silver stand poised to attract further interest as preferred stores of value in a shifting financial landscape. Is rising investor caution and a weaker dollar setting the stage for a more substantial rally in gold and silver? Share your thoughts in the comments. If you found this video valuable, give it a like, share it with others, and don't forget to subscribe. Only 2.6% have. So hit that button and turn on the bell for more insights on gold and silver.